Great. I'm happy to be here.
Hello, welcome everybody. This is our bi-monthly Investor Insights. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And it's a first read of investors and founders and the tech press globally. And every 2 weeks we host these breakfasts. And besides this, I also work with founders on their pitch decks because you guys know this in Virginia, and the investors know it too. You guys don't know how to write them. And your executive summaries, and we make introductions to strategics and to investors where and when appropriate. And that information is also in the newsletter, and I'll put the link in the chat as well. And I want to thank Joseph for hosting us. Joseph, tell us about yourself.
Pleasure, Bonnie. Thank you. Thank everyone for being here. Excited for today's conversation. So Joseph Katz, I'm a marketer. I help companies go from unknown to well-known. I basically help companies utilize the best and sometimes overlooked marketing strategies to grow their business. So if you or anyone you know is looking to grow their business, go to market, I'm happy to have a conversation one-on-one, and leave it at that. And everyone should feel free to put their contact information into the chat. And I'll also share a link to recordings and so forth, so you can see previous events.
So Virginie, it's wonderful to have you again, and with your, well, not so new fund anymore. So you want to tell us about yourself and your background and your new fund, or do you want us to go around the room and have the attendees introduce themselves first? It's up to you.
No, I'm happy to provide some context. This way people can target their intros accordingly if they'd like. So I'm Virginie Raphael. I'm the founder and managing partner of a fund called FullCircle. It's a pre-seed fund that I run as a solo manager. The goal is to invest in companies that can create a more equitable workforce. So to me, that means either putting people into jobs who otherwise wouldn't have those jobs, or preventing people from dropping out of the workforce involuntarily. Think people have a job they love, they quit because they don't have childcare or elderly care, or healthcare, or the support necessary to continue doing a job they already have and love, and that creates massive labor shortages that we really ought to address. So 50% of the portfolio is HR tech, people tech, whatever we want to call it, but the rest of it is pretty broad, going from healthcare to the caregiving economy, as it's been referred to. The way I got there is that I have a public policy background. I thought I wanted to be a diplomat when I was younger. I thought I wanted to work in government, and that was the only way to make an impact. The most possible number of people in the shortest period of time. Realized along the way that I was wrong, that at least government was not the only way, and that it was going to be way too slow for me. So I started in banking instead. I was in public finance. If you don't know what that is, municipal bonds, raising funding for state and local government. I started at Lehman, the summer of '07, which was quite an interesting time to start a career in banking, let alone Lehman, but I learned a lot. Did it for about 5 years. I was recruited out by someone I had met at Lehman. His name is Bradley Tusk, and he was starting a consulting firm, regulatory and political consulting firm. So I have continued to draw on that public policy background and try to infuse it in my work to this day. It's a pretty unique background, and there's not a lot of VCs who have that regulatory background. So it's been really helpful to me. I spent about 10 years at Tusk, which, if you're not familiar with Tusk Ventures, are the regulatory guys. Came to fame because we advised Uber really early on in their regulatory strategy. And Travis Kalanick insisted on us taking equity for better alignment, as he called it at the time. That was Series A. Obviously not a bad first bet into the venture market. And so we evolved into a venture capital fund eventually. I did fund 1 and 2 with them, learned a ton. And by the time they were ready to raise fund 3, the strategy had evolved in such a way that it was no longer suited for what I wanted to do. So I left. It was September of 2020, mid of the pandemic. And 6 months after that, FullCircle was born. So here I am. This is the journey, and a little bit more about FullCircle. And I'm happy to be here. Thanks, Bonnie and Joseph, for having me. Oh, you muted, Bonnie.
I'm so sorry. Didn't want to put noise in the background. We'll have the attendees introduce themselves, and then we'll open it up to Q&A. So the first person on my list is Michael Devine. I hope I'm pronouncing.
Good morning, Michael DeBenny. I'm an investor in infrastructure, digital divide, electricity, water, etc., coming out of a financial services background, and workforce development is top of mind right now. I'm trying to fund a number of U.S. factories with needing workforce programs and working with philanthropists. And I'm a consultant to the Vatican on workforce development for about the last 10 years, refugee camps, et cetera. Thanks.
Let me get to my, oh, I'm sorry, my Zoom is being weird. Francisco, or Francesco, I don't know. Which one? Francisco, do you want to introduce yourself?
Yes. Hi, Bonnie. Hi, everyone. I am Francisco. I am in Mexico. I am an individual investor. My background is investment banking. So hi to everybody.
Oh, thank you. David Page.
Oh, first of all, Bonnie, I'm a huge fan of your work, so thank you so much. I've been following you for many years.
Oh, thank you.
Just awesome. I'm David Page. I am a co-founder and a seed investor in Recovery Jobs, and we look to bridge the gap between employers who need entry-level hand raisers and people that are in recovery from SUD and AUD who are referred to our jobs board from a therapist or a sober living home or a late stage treatment center or a collegiate recovery program or a family therapist. So these are trying to get these people an entry level job, and a lot of employers are looking for hand raisers for those types of jobs.
Oh, fantastic. Dean.
Hi, Bonnie. Thank
Hi,
you
Dean.
for welcoming us. And I'm Dean Margolis. I'm the founder and CEO of Red Sky Health. We're using machine learning to fix health insurance denials for group practices and hospitals. So when they make their claims, about 15% of those claims to insurance companies are denied, and we're using machine learning to get those denials fixed and resubmitted for approval and payment.
And I will add that Dean and I go way back. Dean is a very successful serial entrepreneur. Ray.
Hi, Bonnie. Also a huge fan. I am the founder of a platform that moves digital assets entirely over the internet with no intermediaries, making things much cheaper. The biggest MVP that we have is peer-to-peer payments, completely disintermediating Visa, MasterCard, and their rails, which saves merchants and consumers material amounts of money, 50 to 70% on transaction costs, and it provides rewards for everyone. So we're working with some stores that do low cost, high volume dollar stores, because all of their people that pay with cash or debit cards, they never get rewards. With our process and platform, everyone gets rewards equally.
Thank you.
Thank
Ken,
you.
how are you feeling, Ken? I know you're just getting over being sick as well.
No, I'm doing much better, thanks. Yeah. Hi, good morning. I'm Ken Deering, CEO of iGuard Home Solutions. Our forte is as an age tech solution. We help aging in place parents safely remain in their home when impacted by cognitive memory. And the benefit to the family caregivers like we have in our family is, when they're up first time in the morning, if they didn't get up in the morning, if they have increased memory issues because of the monitoring we do of their cooking activity. And if they can continue cooking safely, they can remain independent, which again relieves a major burden to the family caregivers. Thanks.
No, thank you. Scott Purdy, our entrepreneur and voiceover star.
Am I on? Can you hear me?
Yes.
Okay, good. I was sure if I was on or not. I'm one of the founders of Sine, an organization that we're making a product, I guess you could call it an app, that's going to allow people to upload multiple videos from anywhere at any time, different people into the system, and it will create a fully professional edited video once it's finished. So we're in a section now. We're just about ready with our product, and we're going to be looking for some seed money to help us pay the people developing it, because developing the AI and it's going to take some people with some experience in that. So we got to pay the But anyway, we're looking for that, and I am here this morning. Had an eye surgery the other day for a new, if anybody's had their cataracts done, and it's wonderful. It works really great. And I'm also a part-time actor too. So if anybody needs some acting for anything they're producing, I'm available. But I've been coming to this for a long time. I stepped away for a little bit. I recently came back as we made some changes with the organization, and I really love coming to these meetings. Thank you.
And we're happy to see you. Annie.
Hi, good morning all. Nice to meet you. I'm Annie, and now I am a project manager by day and an influencer strategy by night. And basically, I am the matchmaker between the client side and the creator side. So I'm willing to chat if you are interested in social commerce. Thank you.
Oh, thank you. Beverly. I'm so glad you could make it.
So glad that I'm here. Good morning, everyone. My name is Beverly Hines. I'm the founder and CEO of Hair Scripts. That's the direct-to-consumer wellness platform that gives people of color access to personalized prescription treatments for hair loss via a subscription. And I am claiming myself as Bonnie's mentee. And also, if I just be very, very honest, I am proactively looking to start a seed round. Thank you.
Yes, I was mentoring at Boundary Institute, which I love to do. Brian, welcome back.
Morning, everybody. Hey, Bonnie, how are you?
I'm good. How are you?
I'm coming in from the New York metro area where it is now 25 degrees. I'm so excited. We've gotten out of the teens. Anyway, my name is Ryan Hurd. I'm the founder of Caregiver Smart Solutions, which is AI for aging in place. We are a simple and effective way to know for caregivers across America and the world to monitor, assist, and ensure the safety of their loved ones that are living on their own, because we all deserve peace of mind all the time. We have been B2C. We're now currently focused on B2B2C on the employer side. So we're giving value to employer benefits programs, just like childcare, just like healthcare, just like other things. Here is a way where employers can really enable their employees that have aging loved ones. And of course, there's more and more of them to be, help them out and be more focused at work. We are currently raising. We actually got rug pulled by our investors in the 11th hour. So that was great. Happened 2 weeks ago. So if anybody'd like to talk about money, I'd love to talk.
I could go into that forever. Brian Peterson.
Hello. Yeah, my name is Brian Pearson. Brian Pearson Jr. I am the founder of EDU Rain. We provide colleges with this housing marketplace for both their on and off-campus housing. Students can find roommates, housing, and build credit. Landlords and college admins get dashboard. All parties win. We are raising a seed round, and it does seem like we meet the thesis of the presenter today. So I will be following up with them. And I am going to be in New York next week to meet with investors, presenting at 1 Million Cups. I have an ad on Times Square, thanks to Brex for Free, with quotes from college administrators across America that are using our product because they want to grow our college partnership base. Thank you.
Good for you. Congratulations.
Thank you.
Craig. Always good to see you, Craig. You're muted at the moment. No.
Bonnie, it's great to see you. I'm glad, it's 6:30 out here in LA, so I finally was I was finally able to find a quiet spot in order to jump in. But it's great to see Mark. It's great to see you and Ray, some familiar faces here. 25 years in specialty banking, went through a merger through the holidays, and now I'm exploring my next opportunity, which I'm gathering will look like very similar to what I've done in the past with a different brand. I've been focused in a regional bank. My areas of focus are entertainment, family office, GP, LP, commercial. And then over the last year, as you see behind me, fell in love with AI. And so I've been focusing on emerging markets out here in Los Angeles, specifically blockchain, NFT, and AI. So look forward to connecting with everyone and hope I will have the chance to act as a future resource for you. Thanks again, Bonnie, for including me.
Oh, sure. Oh, you will be. Daniel.
Hi, everyone. My name is Daniel Greenblum. I'm the founder of Catch. We build cybersecurity to protect vulnerable individuals from cyber scams. We actually just went live with our first product last week. It's an email scanner. It detects scams without the user needing to open emails. So now that we are live, looking for users, feedback, input, anything like that. But yeah, happy to be here. Thanks for including me.
You should include the link in the chat. I'm sure you'll find some beta testers here.
Absolutely, would be happy to.
Absolutely do that. Helen.
Hi, everyone. Nice to see you all. Also coming from very cold New York this morning. I'm the founder and CEO of Alcove, and we're working to bring a much broader network of soundproof private spaces to serve the distributed workforce post-COVID in residential neighborhoods in particular. So if anyone's interested in talking about that, I'd love to. We're just entering our friends and family and angel fundraising phase right now. But yeah, thanks so much, Bonnie, for including me, and looking forward to learning more from all of you.
Oh, sure. Like it's, as Joseph mentioned at the top of the, or I should say the bottom, feel free to put your information in the chat, everybody. Ian.
Thanks, Bonnie. Nice to be here. So Ian Garmez, I'm based in Toronto. I work for Virtual Film School. I'm the COO. The company is based in LA. And we help train people in content creation. We just completed a cross-Canada course for students with mild handicaps to basically help them re-enter the workforce. So it's kind of relevant to what the speaker talked about, and it went very well. So we're now gearing up for courses to be delivered around the world in different places.
Oh, thank
That's
you.
me.
Joseph, how are you feeling? Oh, Joseph, are you able to talk, or should we come back to you?
Yeah, sorry. I was
Okay.
trying to find the unmute button. Feeling better. Thanks for asking. I'm a New Jersey-based real estate and early stage tech investor. Nice to meet you guys.
Oh, thank you. Kelsey.
Hi there, everyone. I'm the CEO and co-founder of Monarch. We're a B2B SaaS platform automating the science of leadership development, particularly for new and emerging leaders. We're headquartered out of Calgary, Alberta. I am currently in New York, my first time here, also meeting investors, and we are we closed an oversubscribed seed round in the fall, and so thankfully not going to be fundraising for a little while, but always interested to hear what's happening in the market. And met Virginie, she probably won't even remember, very early on in my journey, probably 3 years ago, and so was really drawn to her as the speaker, and so look forward to being here.
Good to see you again. I totally remember you. I get your updates. I was very happy to see that you closed that round, and very sad that you're still
Awesome.
in Canada. Anyway, yeah, we can talk more.
Good point there. You know, founders always remember to send investors update, even if they say no. I can tell you stories about investors who changed their minds, but this is Virginia's in the spotlight. Mark.
Good morning. Good to see Bonnie and Joseph again, and Craig. Mark Wiseman, I'm Managing Director with Navidar. We are a boutique investment bank focused on technology. We're based in Austin, but I'm in freezing cold and snowy Cleveland, Ohio. Believe it or not, I love it here. But anyway, been coming here for a while. Love to hear all the stories of companies that are, to be honest, too early for us to help them with capital raises, but we're always out there, willing to help make introductions if we can, because we love when these companies grow up and then potentially could use us for their sell-side M&A or later stage capital raises. So great seeing everyone here.
And thank you for being here. Martin Toff.
Hi, Bonnie, and hi, everyone. I'm a former academic who turned into a biotech founder. And for the past couple of years, I have been organizing an investor network for longevity-focused deep tech companies as well. That's where my background is, primarily in longevity biology. So I'm here to learn and connect with the community.
And welcome. Melissa.
Good morning, everyone. I was so happy to actually get the Zoom link from Virginie. I was stalking her and was trying to get into this talk. So just like really glad that we were able to make it. So I'm CEO and founder of Wildcats. We're on a mission to unleash next generation's unexpected entrepreneurs. Bank of America just like ran a survey where 72% of Gen Z are actually all starting their own businesses. But because they're coming in from like such a wider demographic and a younger segment, they actually lack a lot of experience. And so in a lot of our work, we find that this like lack of experience costs a lot of time, money, and like frustration. So Wildcats is a virtual product entrepreneur platform where inexperienced hustlers can shortcut their startup learning curve by buying cheat sheets, startup sheets, tools from more experienced entrepreneurs. We're a lot more of that like TikTok, Instagram crowd, but are a B2B, like I call it little B to like little B SaaS and community. And it's really great to like see everyone here today.
And I did send you the email reminder. I did put you on that list too. Didn't forget.
Thank you.
Nick.
Thanks, everybody. Nick Smith here. I'm actually an investor myself. I've only been angel investing for a little bit. My career has been in enterprise sales. I'm also the chief business development officer of a strategic consulting firm. Very excited to be here. Thanks, everybody.
Yeah, thank you for joining us. Sandra. I know now, Sandra.
Good morning, everyone. I am Sandra Connor. I'm the owner of and creative force behind videogrows.com, where we help our clients to develop and execute marketing and video marketing strategies to attract who they are looking for.
Thank you. Tino.
Thank you, Bonnie. Yeah, thanks for I'm excited to be here. My name is Tino Go. I'm the CEO of Baru. Baru is a post-revenue gig platform for underused manufacturing machines. So think of it like Vistaprint meets Uber, but for cabinet products and machine capacity to deglobalize manufacturing. So we can avoid 40% of the $18 billion industry's cost structure by manufacturing locally and on demand. And so we sell custom cabinets B2B to dealers and contractors for 40% less, delivered 4 times faster. I'll add more info in the chat. We're raising $1 million seed round, so that I'm expecting that we'll grow our sales within to around between 5 and 10 million through the dealers this year.
Oh, thank you. Sam.
Sorry, just had to come off mute. Hi, everyone. Good to see some familiar faces. I'm Sam with Axle AI. We do software that helps media teams put out more and better content by helping them search all the video that they may have. Turns out there's unbelievable amounts of video being generated and repurposed for social media every day, and that is growing. We have 22 employees based here in Boston, and with a pretty good international presence. And as you can imagine, with the whole AI boom, we're really benefiting from a lot of that momentum right now. So anyway, great to be on the call.
Oh, thanks. Alex.
Hi, folks. Good to be here with you all. I'm basically a video creative, filmmaker, and television producer. I create a lot of content, video content for brands and also for influencers. Yeah, that's about it.
Oh, thank you.
Thank you.
Did I get everybody? Because the names keep popping around and I'd hate to miss anybody. I got everybody. So, Virginie, questions? Comments? There are always questions. So
my first comment is that I'm very impressed you got everyone, because I can never do this. The list like keeps, as people move around. So
I know,
wonderful to see how much command you have of your community. Clearly, you know a lot of those folks. So, and I love the diversity of this room. That's my comment.
Me too.
This seems to be one of the biggest breakfast or early meetings we've had. There's a lot of people here today.
You
must be very popular, Virginia.
Let's do it. Questions?
I haven't seen you in public anywhere. Maybe that's why.
Ian has a question.
Oh, Ian, sorry.
Yeah, this is a very basic question, Virginie, but I just wanted to ask about your preferences in pitch decks. I know this is kind of like a mundane topic. I mean, my boss likes all singing, all dancing pitch decks. Bonnie has seen it with videos and a lot of stuff, and I prefer like plain text, just the facts.
Yeah.
What do you prefer?
So here's my view on pitch decks. It can only hurt you. It can't really help you that much, right? So having said that, I think I would have it tight, short, no typos, to the point, right? I wouldn't spend, 40 hours on it. Like, it's always a red flag to me when I get a deck and it's like V46. I'm like, don't you have better things to do to build the business, right? So I think I like having them. I like having them as a pre-read, although, people who prefer to have a conversation or don't have one, like, totally fine. I wouldn't agonize over it. The new trend I've seen is founders putting memos together. I like that too. I think it sort of depends on your style, right? It's sometimes harder to convey some concepts over a pitch deck, so I have no problem reading a memo. Some lazy investors like it because then, their own memo is sort of written up. I don't think it's a great practice myself, but it can be helpful to accelerate the process of some investors. So either memos or pitch decks are helpful from my standpoint. I wouldn't pitch to the pitch deck. Like, I would much rather have that as a pre-read so that we can have a more in-depth conversation when we do meet, and we can keep it conversational, right? So I'm personally not, and this is a style, right? But I'm not a fan of the true sort of pitch where, like, you bring up the slides and you go through the slides. I don't think it's a very good use of time. I think the investors are trying to, depending on your stage, but generally speaking, early stage, the investor is looking to get to know you. And so a more effective way of doing this is by just keeping video on if it's remote, and having a conversation with a human versus sort of talk to slides. That's just less interesting, generally speaking.
Got it. And just in terms of the memo, that's short memo, or what
No,
kind
some
of a
of them are
format?
pretty, some of them are pretty lengthy. They cover the problem, the solution, the product, the team. Some even go to why you shouldn't invest in us, kind of the pros and cons or the risks associated with the investments. I think it's a good thought exercise for a founding team, just because it gets you to put yourself in the shoes of the investor and kind of think through, like, all right, well, how would I look at that from a completely external, removed, standpoint? So I don't dislike the memos. Actually, they've become quite popular. Some of them are pretty detailed. Yep.
Thank you. Very good.
Yeah.
Virginia, a quick question. I usually ask this over the years. When you're looking to invest with someone, what are the top 2 or 3 main things that you look for? Because it's changed over the last few years. It used to be people used to say, oh, we want to see how many users you have, let's say, if you have a product. But now it's not always just that. So at this point in time, what are you looking for in an organization that would make you want to invest in them?
Yeah, emphasis on at this point in time. You're right. The goalposts keep changing. I invest at pre-seed, right? So I'm very comfortable pre-revenue, pre-product. I will say that I spend the most amount of time with the team. I make 8 to 10 investments per year. I have a $10 million fund, and I cut checks of around $200K, right? So to me, the team and how I can interact with them and whether I can bring value to them truly is important. I just don't cut enough checks that, like, I want to work with a team that I don't click with, that I clearly understand the vision, and that I can get behind them and truly help them. So that's number 1. 2, in the current market, funding risk. That's huge. I've had to become increasingly clear on my communications in terms of what it means if I commit. The round needs to come together, right? My $200K check becoming part of a $400K round that was supposed to be $1.5 million doesn't help anybody. Doesn't help me. Doesn't help you, right? I need the company to be properly capitalized, as in have 12 to 18 month of runway, and have a round and investors who will all come and close roughly at the same time. Rounds are taking forever, and it's hard for me to commit upfront and then spend 6 months sort of fundraising with the team, and then by the time you get to the end of the round, you've already spent 6 months worth of what you've raised, right? So it's a very difficult environment where I've always had to put my banker's hat back on and do a proper closing with everybody signing and wiring at the same time. It's not comfortable. It's not my preferred way of operating, but that's the only prudent way of deploying capital these days. So funding risk is huge. And then the third thing that I spend a lot of time on is business model. And I think that's from my time at Tusk. I can tell you that I'm quite knowledgeable about the 1099 versus W-2 scenario, for example, in the caregiving space, right? I see a lot of companies that come to me that have a marketplace model or a 1099 heavy model. It tends not to work, right? Because on a 1099 basis, you can really train those people. And so they tend to churn. The acquisition cost on the provider side is huge. On the customer side as well, because they don't get the level of care that they deserve and think they're paying for. And so I tend to be quite sensitive to the business model. It doesn't need to mean necessarily that the company is already making money. It just means that they need to have a really clear sense of what are the different revenue channels, what resources am I going to need to put against that, right? And how do I think the company will make money? So I tend to spend a lot of time on the model, cash flow model, projection model, whatever we want to call it, not from the standpoint of like, what are the numbers that they're showing me? Because we all know they're going to be wrong. I don't care so much about seeing 100 million in 5 years. Like I see that in all models virtually that I review. But it's more about sort of the thought process behind it and how it helps you think through the business.
Thank you. Appreciate that.
Next question. I want to ask what you think about executive summaries, because you mentioned memos, which I know are a different piece, but an executive summary as a first step before the pitch deck or along with the pitch deck.
Yeah, that can work too. Seen like a one pager. I think it's generally harder to format them in a way that's appealing, because if you try to cram information into a one pager, like it tends to not really look that good. And so I think a very short pitch deck, or a teaser pitch deck as they call it, is just as effective as an executive summary often.
Okay, thanks. Next question. Feel free to ask questions, guys.
Hey, Bonnie, I have a question.
Sure.
So from the investment groups, we went through a couple of months worth of due diligence, the whole 9 yards, and at the 11th hour, we were rug pulled by our investment group. They were outside of the US. They chose this would be their first investment into age tech, health tech. They were comfortable with consumer, and they chose not to. So, and I'm putting myself out there. From an investor's standpoint, does that mean that we have a big X on our back now and nobody wants to touch us? Or does it make sense, especially in this environment? There's a lot of powder on the side, but as far as investment, pretty much across the boards, everybody's sitting on it. So I just love to hear your thoughts on it, or should I just keep my mouth shut about it?
I always operate as a place of transparency. So, people are going to find out. It doesn't really matter what you try to do about it. I think it's always a bad start to a relationship that's going to be very long-term in nature to not disclose something like this, or, you don't need to lead with it per se. I wouldn't try to hide it. Right. Give me a little bit more context, like how much are you trying to raise, where are you at with the business, kind of what stage, that type of stuff.
Yeah, so we're product in market, we're profitable, we've got product worldwide, Japan, Canada, UK, across the US. We're looking now to expand. We were raising 2.5 million. We just started a pilot with Verizon. We're going to start a pilot with Japan through a group that's called the Carter Group. And basically it just comes down to I am self-funded up to this point, but my funding allows me to maybe crawl. I need to start running or sprinting.
Service customers mostly? Is it sort of a sales customer success, lots of hires? The product seems to be in decent shape, right? Is that mostly what the money is going to?
Yeah, we're hardware as a sales, so we charge for product as well as a monthly monitoring cost. Again, we're out there, we're profitable, we're paying our bills, all that wonderful stuff, but now it's time to really expand. So we're trying to remove as much of that I don't even know what the word is, but risk. We're trying to remove as much of the risk before we go and try to get money to expand.
And do you need to go on the VC treadmill necessarily? Because if you're profitable already, there could be other ways of funding the business that is not requiring you to go through that crazy process again.
Yeah,
That's
a
my favorite.
that's a
Is find
great
a strategic
question.
partner. Like if yeah, I'm not sure I would go through. I don't know how traditional the funding partner that you had that dropped. First of all, that happens all the time, right? So lesson learned here is like never
Yeah.
put all of your eggs in one basket. Like until the money hits the bank, I don't care about term sheets. I don't even care about like full on documents about to sign. Like things happen to the very last minute. So like never count anything until it's actually literally in the bank. And so always have more.
Yeah, that's a great
a
question.
few processes going on at any point
That's
in time.
great points. And I don't even really sure if I need to go the VC route and or maybe just do a small seed or just keep on going along. I think as I project out and presume we're going to have a successful pilot with Verizon, that's where it comes in where we can go from our numbers now to deploying 1,000 units, 10,000 units, 1,000,000 units. I know it's a long-term thing with a joint venture like Verizon, but then the question is, I guess, how do I strike that deal where then I don't have to go out to VC to get money to manufacture a product or dev time or that kind of thing?
Yeah, I would think through sort of the type of deals you get got on the hardware side. I don't know if everything is off the shelf or anything is, but they're interested in distributing their products. I imagine, can work some deals there in terms of when payment is due, and then on the customer side, right, they really want this, they can pay more upfront than they otherwise would, perhaps, especially if there's a hardware component. I think I would explore all of that, and if you're already profitable and like you have all those customers, like the best way to fund this business is revenue. Yes, I recognize I'm a VC and in the business of deploying capital, but like VC is not the answer to every company necessarily, or the best funding source depending on where you're at. So if you own 100% of the business and you can find a really good partner who can be on your cap table and own percentage of the company in exchange for a lot of other things other than capital, right? Maybe they have working capital, maybe they have line of credit, maybe they have ways that you can finance your hardware and still continue to grow without necessarily having to go on the VC path. I would definitely urge you to consider that, especially the current market.
Thank you.
I want to mention that one of the companies I work with did a partnership recently, and this partnership, are they going to put in money? We don't know, but it's going to bring in over 200 million in revenue a year. Never underestimate partnerships.
Yeah. I just want to ask Ryan a quick question. Ryan, is one of the things you're looking, maybe you have like a little bit of a cushion in case if things like really took off, costs, the costs of storage and the data and everything could rise quickly, maybe more quickly than you can afford.
Yeah, be careful what you ask for, right? So especially with this Verizon partnership, what we found out is they're very interested in this sector in age tech, health at home, aging in place and whatnot. And it makes sense because it goes down to how many homes can we light up, kind of from a security model or a reoccurring revenue model. They're supplying, whether it's cell phones, whether it's internet, it just goes to how many homes can we light up. This goes into their thesis. They actually have a spin-off within their company, so they have a whole group of people working on this, and we have a very good relationship with that. So not only is it about a successful pilot, some of the things that we're focusing on doing is how can we bring more value to the customer. Kind of like iGuard with Ken. We got to talk again. But at the end of the day, things like when you take mom out of the house, put the home into an alarm state, because we are passive monitoring of habits of the loved one. So yes, we're going to have increased server costs. We're going to have we'll lower the hardware costs, but we'll have to buy and manufacture much more hardware costs. But I think my first cost is going to be more dev time, coming up with different ways we can use the product to add even more immense value to that end consumer.
Sorry, next question. Feel free to ask any question that you have.
I have one.
Yes.
So we're in an unusual spot because we're actually cash flow positive at the moment, and we're growing, but we'd like to grow faster. We've never actually done a proper seed round. We've done some equity crowdfunding, some accelerators, but we're largely bootstrapped. What kind of advice would you give for somebody who's looking to kind of accelerate the growth of the business, but not, not go nuts. Particularly our growth, we probably grew about 35% last year. So we're not growing fast enough to meet VC expectations yet. We might be able to grow it more like 50 to 100% this year, but even then, I think that would make us kind of underachievers in the VC mindset. So, what are your thoughts on potential sources of funds?
What's your business model?
We sell software, and then there's a SaaS portion. Our business is basically 1/3 sale of software licenses, 1/3 SaaS, and 1/3 maintenance contracts.
Okay, and how long have you been in business?
5 years.
Have you explored revenue-based financing?
We actually have.
If most of it is pretty recurring and truly SaaS, there are other. It's a good other way of financing the business.
We have some venture debt. We have a couple $100,000 in venture debt, but I'm leery of loading up more on debt because then the debt service starts, especially at current interest rates, starts to get a little expensive.
Yeah, revenue base is different though. They're underwritten a little bit differently, and you pay it out of revenue. So I can, if you follow up with me, I can send you a few names of people who do revenue-based funding for SaaS businesses.
Okay, super. I'll do that. Thanks.
Sure.
I've got a quick question here. Just like wondering, especially at pre-seed stage, I think that a lot of times we're trying to like set vision, and especially along a technology roadmap, where things can go. But, so for Wildcats, I think that we've tried to keep it a little bit more conservative at first and just like trying to get like the first big idea across, and our experience, like trying to get like, and then we'll go to this phase, and then that phase has been not as well understood, like when we're just trying to get it across in a first pitch. But at the same time, it's that idea of like, getting like big ideas across. I was just like wondering, like, what's your opinion in terms of, is it just like, what's the first thing that we're trying to first build, trying to get to our first revenue on, or is it like really setting vision to like, especially like where technology can bring us in the future? Because even for us, like, at both at MVP and even with a soft launch, we've stayed, we don't want to like engineer until we have our behaviors, product market fit, things like well proven out, and then get into like the engineering side. But I sometimes like feel that we're characterized as a non-technology company because like we're building off of WooCommerce. But like from a product management standpoint, I'm like, that's not smart to engineer until like really well like what you're building and not waste resources that way. Just kind of wondering like what your opinions are on that.
Yeah, so there's kind of two questions in I think your question, right? There's one, the balance between vision and short-term execution, and I talk about that a lot with founders. I write about it because I think it's really hard to get it right. And then the second is like when to build and actually put into the product what your vision is. So on the first, it's always a really interesting balance to strike between like, can you paint the big picture and get the investor really excited about where it is that you're going and what it looks like if you're successful, right? And so that's important. But at the same time, like I see a ton of companies who often pitch me sort of like 3 different concepts or 3 different products that they're going to need with a bunch of very complicated distribution strategies and acquisition that they need to make. Like that's just not gonna, I need to see that in the short term, you have a very clear plan for how you're going to start testing out whether big vision is actually the path that you want to go down, right? And as a pre-seed investor, like I can't even pretend that I need everything to be like all worked out all the way to the big vision, right? Because you're going to pivot, and I hate the term, you're going to evolve, right? And change what the company is like about, I don't know, 5 or 6 times before you get to your Series A, right? If not seed. And I have to be comfortable with that, right? Otherwise I can't even pretend that that's the stage that I want to invest at. So I think, yes, it's important to have a vision. It's important to just be like, well, what exactly are you trying to do, and what does this look like if this really gets big, right? That's where I get excited usually. It's like, okay, I see what you're doing now. This is a good business in and of itself, but like, really, what are you after? Like, what comes after that, and what do you think you can get to by doing what you're currently doing? That's often the most interesting part of the conversation, but try to strike that balance. On the second part of not building, yes, absolutely. There are a lot of cheap cost ways to build no-code product that can get to a demo or a state of the product where you can start putting in the hands of customers, knowing that it's going to break, knowing that it's far from perfect. You can show it to investors, and it's often helpful to have something because it's really hard to do all of that envisioning and offload what's in your head or put in the pitch deck. Nothing is more helpful than a short demo or recorded thing. It doesn't even need to be a demo, right? Figma, wireframe, whatever we want to call it, like anything that's like either clickable or some sort of a prototype that you can put together is always helpful. So, yes, don't hire a dev shop for $40K a month until you really know what you're building. But, there are plenty of ways to do that short of actually building the tech and certainly putting the infrastructure in place on the engineering side of things. Like you don't need an engineer for quite some time.
That's awesome. Thank you for that.
Yeah, and be careful when choosing that dev shop too. Ian.
Yes, Virginie, you mentioned that you like to see the business model. How much financial documentation should a startup that's mostly pre-revenue put together? Because we've already been asked a couple of times for things that kind of surprised us. They wanted to see a detailed pro forma. What would you like to normally see or have available?
Yeah, it's a really good test for investors. Like look at how they conduct their investment and diligence process. Like I see a lot of seed investors who want to dabble into pre-seed. In my experience, they never cut the check, right? Because they're asking for things that the company doesn't have and shouldn't have, right? And so stage appropriateness and that match, like try to establish that as early as possible, well before you spend any time with them even. Like I get pretty ruthless, and I did that for my own fundraise for my fund. Pre-qualifying people is like half the battle on fundraising. Like it is not a numbers game, right? It is a game of can you properly pre-qualify and have a top of funnel that's like actually surprisingly narrow, and then how many people can you drive to conversion, right? And so if you think about that, like don't hesitate the first few minutes. Don't take 15 minutes of a 30-minute conversation on it, but like the first few minutes of the call, just ask, right? When was the last check you cut? How big was it? What stage was the company? Try to double check as much as possible. Like if they're not a good fit, they don't want to waste your time and you don't want to waste theirs either. And so I would really don't hesitate to do that. Like I don't mind it. I put a ton on my website. I try to be as transparent about that. I don't want to see deals that are outside of my range either, right? And so I would encourage you to do that. That's my first comment. In terms of sort of documentation, the model can be really simple, right? What I want to see is like cash in, cash out. And often what that entails is, if you're starting to think about monetization, like what do we think initial revenue can look like? If you don't have that, fine, right? It can be zero. It can be literally the starting point can be cash in the bank right now. And then your hiring plan, right? That's what I look at. That really helps you set the budget and the use of funds for what it is that you want to raise, and then run that down, right? If you want 3 people and then hire a new engineer ideally in 6 months, that's going to cost you X, model that out. That means that you need to raise, I don't know, $1 million today, right? And how much is that $1 million going to cost you if you do hire the team that you think you're going to hire? 90, maybe not 90%, 80% of what I see is like, a dev shop with the cost to develop like a prototype and then the team, right? But it's helpful for me to see how you think about, okay, really you think you need 10 engineers by the end of the year? Like that's going to cost you a lot more than what you think. It helps you narrow down the range of what you want to raise, and then it helps me see, okay, this is how they're resourcing what they're trying to build, right? This is how long that money will last them. I think they need more. I think they need less. I don't think it's going to last them as long as they think it will last them. That type of conversation is important to have. And please don't have a range that's like so big that it raises questions as to whether you're ready for the capital and or you know how to put it to good use and you know what you're going to do with them, right? Founders come to me all the time. They're like, I don't know, we're thinking of raising 1 to 2 million. You know what the difference is between 1 and 2 million? 100%, right? It's double. Like it's a huge range. And so you can't really be ready for a process if you don't know if you're raising 2 or 1, right? So having a model brings you to the discipline of doing that and actually thinking really deep and hard about how you're going to use that capital.
Right. And should that model be summarized in the pitch deck, or should it be like separate?
I would have an Excel separately. It just doesn't really translate into a beautiful slide. So just have a good old Excel. Like that could be a bias from my old banking days, but I like an Excel model.
Yeah, understood. Great. Thank you.
Can I follow up that question, Ian? I love that question. Virginie, you were talking about like size of round too, especially like within this market. And any advice for like founders who are trying to decide the proper size? And by that, I mean that, hey, look, I know that like Plan A looks like this in terms of like speed of like acquisition and build, if we're able to get, XYZ on board. But plan B, like, like judging realistically from like the market, how like concerns that you have, how long it's going to take, be able to bring like the whole like round together. Do you have any like opinions on how to put that together? Because I often feel like, okay, we're locked down to like a single number. We want to have like credibility to be able to put out there and like work hard like towards that. But at the same time, like, investment size, we're hearing, hey, you need to be like much larger because like, it's a hard market out there. So if you're going to raise the whole thing. And then on the other side, they're like, no, it needs to be like much smaller because it's a hard market. And I feel like there's a lot of conflicting advice on there. Would love to hear yours.
Yeah. So I hate like it depends, but in this case, truly it depends. I think it helps you narrow down who you're going to target, right? And it depends on, are you a team of 3? Are you a solo founder? Are you based in New York City? Are you based in, I don't know, middle of nowhere, cost of living much lower? So yes, it varies a lot. I think if you talk to a fund, right? I made a comment earlier about funding risk. Yes, like a fund like mine, right? I have no follow-on strategy. I'm not going to be the one to bridge you to your next round if need be. So yes, I would want you to see properly capitalized. Generally speaking, a pre-seed round these days is anywhere between like 1.5 up to 2 maybe, but then dilution starts being an issue, right? So you need to sort of gauge given the stage of the company and realistically what the business is worth, right? And if I have a solo founder situation, right, dilution is not as much of an issue. If it's 3 of them and they're splitting the equity among 3 people, right, then you're a little bit more sensitive to dilution. So there's a lot of factors to take into consideration, right? How much do you think you can raise? How much do you think the business is worth? And what are the needs of the team? Because if I see a team that's swearing to me that they can do it on 500K and it's 3 of them and they're all in New York and one of them has 2 kids going to private school, I can guarantee you that I'm not comfortable being like, yeah, you can build comfortably. Like you can go without a salary, surely, right? Or you can all each take 550K a year for 3 years. That's just not true, right? It's like, I want you to be able to build comfortably and I want you to have a real go. You having 500K and surviving for 3 or 4 months is just not going to help you. It's just not going to help me. It's just not going to help anybody, right? It's often easier to raise more money rather than less, somewhat counterintuitively, I think, because it just opens up different, right? Like, look, can you put a 500K together with a bunch of angels that are completely insensitive to valuation and manage dilution that way? Yes, you can. Does that set you up for success? I don't know, right? They'll cut one check and go away. So I think I would really encourage you to think through okay, how much time do I want to dedicate to fundraising, right? Do I want to start down the path of talking to funds or not? And I know that's going to take longer. And what is it that I'm going to do with the money, right? And how much do I need to build comfortably? And am I at the stage where I'm ready to actually deploy capital effectively? If you're still sort of unsure what you're doing, maybe don't raise now, right? Capital is a means to an end, right? It's not a milestone. It's not a sign of success. It's not a sign of anything other than, man, I need capital to continue building this company, or I'm ready for it now. It is nothing else, right? So if you adjust your mindset to just be capital is solely a means to an end, right? Then you go and do it, right? And the raise goes much better. That's about the rightness of the business and how much time you want to spend on it. Does that answer your question or helps?
Yeah, no,
I know it's sort of a non-answer, but it is truly company specific and founder specific.
I appreciate the background mindset of how you guys think about the size.
Thank you. Tino, been waiting patiently.
Yeah, so about round size, I'm raising $1 million and a lot of people call that an angel round. Because we've de-risked our technology, we're in market, we have our first dealers, and we just need to, I need to be able to monopolize some of my co-founders' time as opposed to having them only work part-time. And from 2000 until 2020, I was either in corporate finance, whether banking or CFO roles. from, you know, overseeing companies as small as 12 million, as large as 1.2 billion. So when I talk about funding, I talk about scenario planning. And so if you look at, you know, given the fact that we have our first dealer, and we have others in the pipeline that will generate gross margin that funds the company. I mean, it's an unusual business because we're selling cabinetry, and we have competitive advantages that no one in the industry currently has or can compete with, because this hyper localization eliminates so much cost. I believe that we can really, you know, with $200,000, we'll get to $1.5 million, $2 million within the next 6 months. And with $1 million, we'll get to over 5 million, probably approaching 10 million in 12 months. And so how should I approach my ask? Because I really believe what I'm saying, because we've, you know, with, to get to date, in what I'll call our pre-seed round, which has been a rolling close since 2019, with, you know, only providing 2 months of runway at any given time. We've gotten 250,000 sales and manufacturing in 17 metro areas. So the technology is de-risked. Now we've automated, and we've created that process automation that makes our operations like DoorDash, except for our average sales order is going to be between $10,000 and $15,000, dropping a third of that to reinvestable gross margin. Because unlike the rest of the industry, we have no CapEx or inventory or working capital needs. And so how do I think about round size? I mean, speaking with you, I just said $1 million. Speaking with an angel, I'm talking about $250,000 initial tranche with optionality for other tranches. And I could be effective and judicious with up to 3 million.
So how much have you raised so far, and over what period of time?
476,000 of angel funding, $25,000 of a grant, and over 200 of my own since 2015.
Has it all been in safes or convertible notes with different caps?
Yes, the 476 has been in safes with caps ranging from 4 million to 8 million.
Okay. So you are probably at the point where it makes sense to clean up the cap table, have all those safes convert, right, and have a price round of some kind, it sounds like. Not that there's not other ways to do that if you decide to, again, go off the VC train. You're profitable, or you have revenue, at least, it sounds like?
Yeah, we've got revenue. The past year, I declined revenue. I actually returned funding because we were building infrastructure, because our beta in cabinetry was done the old-fashioned way, and the old-fashioned way was my learning process. And this year, we're about to, in a couple of weeks, we're about to deploy this Vistaprint like user front end, and it's process automation is what it is. And
the team and the monthly burn looks like what?
It's around 6,000 a month right now, with no salaries.
No salaries on any one of the team members, and it's you and how many co-founders?
3 part-time co-founders. The one who's really critical is my manufacturing engineer, because they haven't gone full-time because of lack of funding, or because of other reasons? He still needs to support his family.
Okay. So here's what's a little bit atypical about your situation is the length of time that has been going on. So I see this early on, right, where it's like my co-founder will join if and when the round comes together, but it's a matter of they've been at this for about 6 months, right? They're still ideating. One is highly technical and has built the product, moonlighting, but there's something there, and they're thinking of really, going for it, but they're not going to quit their job until they do that. Typically, investors don't like it if at least one of the co-founders is not full-time. If one of them is part-time, subject to like funding being raised, that's usually okay. What's going to be a little bit confusing to investors in your situation is you've been doing this for, since 2015. So like, it's going to be a little bit harder to trigger what's the inflection point here that, has taken so long to get to, and why now? Like, why would you co-founders join now? Is it really just a funding issue at this point? Like, it's a little bit harder to believe, I think. So narrative and storytelling is going to be really important to you. I think round size, if you have proof and or LOIs or like, a good history of like why you've refused customers in the past and how much revenue that would have translated into if you had that particular thing, maybe there's a case to be made. If really the only other person who's critical to the company is that engineer, and it's just about paying them, like, yeah, go the angel route, right? And don't, why raise a bigger round now and why go down that path now? I think that's going to be a harder story to tell, if that makes sense.
Yeah, the time has been idea investigation and iterating through alpha. Our first customer was Google in 2020, and we were selling and making custom desks for Googlers as they were setting up home offices. And so that was our first true technical test. And we sold and manufactured in 12 cities around the country. So we proved that, okay, with furniture, this works. Now, how do we get into a more scalable product? And that was cabinetry in late 21. And my whole thing was selling and producing and delivering custom cabinetry, but the old-fashioned way without having my own factory. That I knew that wasn't a scalable process, but I needed to understand the industry before I could disrupt it. Now we built over this past year, we declined sales that were going to be marginally unit profitable marginally in favor of just focusing on building infrastructure and not consuming engineering resources, my team members' resources on something that wouldn't move the needle.
Yeah, I almost feel like finding a family office or someone with operational, it seems pretty operationally complex, or at least local, right? Going to a partner that has like a bunch of businesses that they used to operate or still operate, ideally sort of within your category, they may have a better understanding of it, right? Look, my only caveat to that is that they're both wonderful and tricky because, first of all, you don't know, right? They don't hang up a shingle, and like angels, like there's some amount of branding and marketing that some of them do that you can find them. At least family offices are really hard to find because they like to be very discreet about their investing activities. They are unequally equipped to do direct investment. Some of them have no idea what they're doing, to be perfectly candid. And so it's hard if you deal with a family office like that. Like, they might want a ton of your cap table. They might set a valuation that makes no sense. But if you find a good one, I think they can definitely be the one to like set a price on this. They might want not a controlling stake of the company by any means, but like a decent chunk of the company for what they're doing. But if this is the last time that you have to do this, I would think of it more as like, if this is my last round, I want to do this right. I want to raise the right amount that sets me off for like, we're off to the races after that. And so find a strategic partner that can clean up the cap table, converts all the Cs. But I'm not sure you necessarily need to think of it as like, oh, well, that's it now. I'm going to raise that round and then the next one and then the next one. It doesn't seem to be a business that will need to raise an enormous amount of capital for like multiple rounds, multiple years, right? So that's the case. I think I would think about it a little bit differently.
Yeah, and so, but actually what I'm planning, what in my mind I had planned this $1 million round, grow it to 7 to 10 in the first year, and our expansion plan is an early adopter route because it costs us nothing to be in every metro area nationwide and possibly even worldwide in the high labor cost countries. So by capturing the early adopter strategy, we can grow it to hundreds of millions of dollars. You know, 2 kitchens a month per million population takes us to over $100 million in the US. And a third of that will be gross margin, which for us is growth capital. But there's also the optionality of raising a Series A. And if I went to angels, I know the path to Series A. If I went to family office or a non-venture type of investor, how would that affect the Series A? In your opinion, or I'm spitballing, sorry.
Yeah, no, I mean, look, it's always hard to say, right? These days, as I said earlier, the goalposts just keep changing. It's very investor specific, generally speaking. You need to think about it. You're thinking about it the right way. Right? You always need to think about what would future investors sort of think of what I'm doing today. And it's hard, right? Because you're trying to raise the current round. Anytime I encourage founders, just be like, what do you think you need to be to raise a seed? And like, I'm sorry, I'm raising my pre-seed. I'm like, no, I know, but what do you think you need to, what are investors going to ask you? Because we need to walk backwards on that. But it's really hard to say without knowing more about the business and what the market would be like when you do indeed need to raise a Series A. So it's the right way to think about it, though.
Thank you.
Can I ask a question?
Sure.
Okay, so with my company, we've honestly, in our industry, we are crushing it right now. We've been able to differentiate a product. We've been able to win RFPs against competitors that have exited. And like now, like being in Techstars, it has been super aggressive because we have so much traction from my individual college partners that like it's just been hard to do anything. And like when we go out and talk to VCs sometimes, like they don't understand that we white label our software for colleges, and that like they're not understanding that like it's the college's software. They have their own website through us that's activated through their web address link with like a vanity link, and it has all the colleges running on it, and the university pays. They pay us for on-campus housing, and they give us all the contracts of the property managers and the students at the school. So like it's a model where it's a freemium SaaS model for the college, and it is a multi-tiered property management model, and it's free for the student. And then we have like a partnership with service providers like Lemonade's Renters Insurance, TransUnion for background checks, that give like this like renter's guide for the student and the landlord so that they can interact and have everything that they need. And like people say it's like, oh, this is like a little confusing. I'm like, it is a simple property technology site that has been white labeled for the school, that has integrations with their identity management system, like single sign-on, so every user is verified, and we have 4 different types of roommate match. Like it is a very simple product that is winning in market. Like, what do you understand or do not understand about it? And does that something that interests your appetite just from talking about it? And like how, like we've had over 9,000 users in the last 12 months in 41 different countries. We ended 2023 with over 2 million in revenue and LOIs. And like, I'm like trying to extract that value of revenue. And there's just colleges signing the deal. They're like, Brian, y'all have won. Investors should just cut y'all a check at this point. There's a clearly differentiated model. There's a clear way for you guys to make revenue. Like, and like we've been suffering from, and honestly, 100% of it has not been women. In fact, we have seen women try to get the deal pushed and be blocked by some random man that knows nothing. And like I've seen that in the last like 2 weeks, where like there's like a woman trying her hardest to get the deal signed based off of facts. And then we come to a field fact situation with some random person because I'm like some like Black LGBT man. And I'm just like, that's part of the reason why the colleges want us, is because their population is growing with diversity, and we are making housing an ecosystem for all students. And 99% of the time, students have money to pay for rent because they have to go to college. So like we have an audience that we can actually do that with and win. In fact, HUD did a study of our platform And it was like, you guys are going to win because of the audience that you have. Okay, I just said a lot, but go answer that. Think about
You did
that.
say a lot. What I would propose is that you send me a demo of your product, a deck, whatever you have, whatever you want me to look at, and then we take it offline and talk about all of those different things. Unless people are particularly interested in me sharing thoughts on, like, you threw a lot in there, and so it would take a while, I think, to untangle all of that. But I would want to know how long you've been at it, how much you've raised so far, if anything, and yeah, kind of where that revenue has come from, right? Is it recurring, not recurring? Like, how did you get to those relationship ecologists? I think generally speaking, investors have a little bit of a reluctance to, if it's too good to be true, usually it is. And so they need to do their diligence. And I don't know why they can't wrap their head around what you've built. They could be a reason, they could not be a reason. But yeah, either way, I'd love to learn more and chat more about all the different points that you raised. I can't even comment on the, like, diversity, stupidity. Well, we can't get there, but it would take 3 hours.
Well, it's just been an interesting data point that we've seen. That there's a woman that does a lot of the due diligence actually on the deals, and like that is our biggest champion. And like, so there's still like, so right now we're pitching about 190 groups we've been communicating with through the program. We're trying to get that to 250 by the end of next week. And then we want to have deals closed or soft committed within the next 3 weeks. And then we're going to be done. And like, we're going to be just chopping up who's interested, who's soft committed, who wants to put money in the bank, because so many VCs, it's a numbers game. And there are already some folks that are soft circled in our round. I'm just like, I'm one of those people, I look more at the people who said no and like, what was that no for? Because like, that is how you grow, but you do also want to grow. Yeah. So
when did you finish Techstars and which program did you go through?
Tulsa, and we did that demo day was last Thursday. We did that. We've only been around for about 2 years with this product. We started partnering with colleges in 2023 at the end, and then we signed our first deal last year. In 2022. I'm sorry. We signed our first deal at the beginning of 2023 with a small college. We signed a major market college, Cal Poly, which is a major D1 school in America, in about like March. And then literally yesterday, we signed a global college that's 25 campuses across the world, Webster University. And so like now it's just like, we're just going to win because like we have market presence. We can grab because before it was like you got to grab colleges like kind of all over. But now since we got Webster, we have a base in 25 different markets to just keep adding colleges to and serving that real estate market with students.
Got it. Cool. I love your energy. I'd love to learn more.
Okay.
Do you want me to send everybody your contact information so you don't have to put it in the chat?
You sure can, but also I'm very easy to find.
Okay, that's
or should be. That's test number 1.
So next question. Because you mentioned something that I don't think. Oh, Ian, go ahead.
Oh, just a quick question. But what would you say is the biggest mistake that is made when founders are pitching to you?
Not following through. If you say you're going to do something, do it. If you say you're going to send me an updated deck tonight, do it. Don't wait until the morning. And apologies for the little, whatever. Like little signs like this, like you'd be shocked. I try to be generous with my time. There's some founders who fill out my form on my website and are pretty thoughtful in their outreach. I try to respond. Ask Melissa. She cold outreach to me. I did respond. It's hard, right? The volume is ridiculous. But if it's done thoughtfully, I will do it. Don't pretend that you've read my website if you haven't. Like it will be immediately clear to me based on the questions you asked that you haven't, right? And so I think consistency and follow through is like, to me, to this day, the biggest shocking mistake that founders make, right? Some will ask me for like time, a pitch feedback, like, do you have 15 minutes? I understand I'm not a fit, 15 minutes of your time. Occasionally I say yes to that. Time and again, I'm disappointed because people don't show up, right? Don't call me when they said they're going to call me. It's like, it's on you, right? Like, I don't care. I really don't. But it shows me that,
You're.
Oh,
Might be.
did she freeze?
Yeah, looks like it.
Oh, shoot.
Right in the middle of the answer. Too.
I know, it shows me that. Oh, I
Well,
wonder
she'll
if
be
she's
back in a minute,
Yeah.
probably. I guess those are like tell, like, like they're tells in the sense that what she gets from that is that maybe you would not be reliable later on in the.
Oh, you froze there. So when it shows me that, and then it went silent. Virginie.
oh,
Her
did someone
audio
not
probably.
hear me?
Yeah, we didn't hear what you said for a little.
Yeah, we didn't hear you.
About a minute.
Oh, I was going on my soapbox about follow through and doing doing the things that you said you would do. I think success can be demonstrated. It takes a lot of determination and it takes a lot of consistency, right? And people notice. I send my monthly newsletter to my investors and my prospective investors by 7 a.m. the first of every month, unless it falls on a weekend, in which case it comes out Monday at 7 a.m. The number of investors who come to me and say, first of all, most amount of insights I get from any of the newsletters are great. So content and quality is important, right? I'm not saying just like hit the button and first of every month, just send crap out. But most of them notice that it does come out on the first of every month because most of them, have funds who say they want to add you to their update list and they maybe get, on a very ad hoc basis once or twice a year, right? An update from that fund. It's fine. Again, you don't need to have a monthly newsletter if that's not your thing. But if you say you're going to add them to a monthly update and you say you're going to send that monthly update, do it. I think there are little ways like this where that you can pick up on a team that's like at bare minimum, not sufficient to be clear, right? But has the necessary sort of consistency and follow through that will be needed to build a company and succeed because it takes a lot.
So I guess you see those like tells in the sense like the way they behave in that situation predicts the way they might behave in other situations.
Yes.
Right. So the question of trust. Right.
Yes. If there's, a bunch of typo in your deck, like you send me an email, you can't even spell my name right. Like, all right, well.
Yeah, got it. Makes sense. Thank you.
I know Tino has another question. I just want to mention that there was this founder who was raising her seat and she would come to every single investor breakfast. Didn't matter if it was later stage, AAC, whatever, and always stayed in touch with every investor. Then when it came to raising her A round, the two lead investors were two investors she had met at the breakfast because they knew her by then and kept them in the loop.
And the key is to do it sort of genuinely, right? Like, so not to put Melissa on the spot, but like, okay, she filled out my form or reached out to her email, I forget which one, thoughtfully explain what she wanted to talk to me. And she said, oh, by the way, I really wanted to, I saw you're speaking at this thing I really want to get into, like, can't do it through the Eventbrite or whatever. Thoughtful, right? Like, look, am I going to invest in her business just because of that? No, of course not, right? But like, I think if you need to stand out, right? I review about 100 deals a month. And as I said, I make 8 to 10 investments per year, right? That's a 1%, very typical. Like most investors are that way. We say no to 99% of the things that we see. So any way that you can sort of stand out, right? Any way who's going to put a note in that little, at my form at the bottom, there's a little note like, why do you want FullCircle? Like anyone who's like thesis alignment, I'm like, all right, well, tell me more. Like, what about our thesis is aligned, right? You got to find a way to be top of mind and B, stand out, right? It's hard to do it and to do it consistently well, but it's critical because it's an industry where things move fast. And if you don't give people a way to just be like, oh yeah, I remember her, like I met her at this thing, or she was chasing me down after this event, like, could make a difference. You never know.
I know that Tino has another question.
Yeah. Would you be interested in being on our updates list?
You're very far afield, I think, from what I'm doing usually. But happy to see at least the first few and see. I do read them crazily enough, and I do try to respond to them. So if I say yes to that, usually it's an indication that I am interested in following through. So
Yeah, so maybe what I'll do is I'll send you just like a 2-pager and the latest update, and then you can. Okay, thank you.
That sounds right. Sure.
Hi, so I have a question. It's Beverly
Yes.
with Harry Scripts. Now I have a few questions based on everything that was asked, but I'll make it quick and simple. For the newsletter, what kind of updates would investors like to see on that newsletter?
So there should be 2 versions, right? If you already have investors, obviously they'll get more information than a prospective one. Always put on top sort of like, this is Beverly from, I forget the name of the company. We do XYZ, right? Because I get a lot of those every day. And so it's always helpful to just be like, oh yeah, I remember that, what they're doing. And then on the very top, the key highlights, people might only read those like 3 or 4 bullet points. You can get into a little bit more detail for the people who follow you a little bit more closely and want a little bit more. And then I would always do shout outs at the end to force people to at bare minimum scroll to the end. People love a shout out. Like any asks that you have should be stated very clearly, right? And then any shout outs from the month, from the month prior. Thank you so much to Virginie for the intro to XYZ, Voice Critical, right? Or it incentivizes people to help you and actually deliver on your asks, and people love to see their name on this thing as someone who has been helpful. So always have a shout out section. I think that pushes people to read and see if they made it in that particular month.
Thank you so much. Another thing, as a pre-seed investor, and I'm pre-revenue, pre-launch. So we're planning on launching in the next 2 to 3 weeks. So what I've been using as traction in my conversations is my community. I've been able to build a robust community of my customer avatar. So I have about 19,000 subscribers on YouTube, 5 million impressions, et cetera, et cetera, et cetera. The list goes on. And a ton of people who have expressed interest, raised their hands and said, we're ready for this launch. But that doesn't seem to translate as traction to a lot of the investors that I'm speaking to. So 2-part to that question is, how do you view community growth or community numbers, volume as traction? And 2, if you don't see it as traction, post-launch, what kind of benchmarks should I be looking for? So when I do send out that newsletter, people are excited.
So I think I would question the need for traction, right? Like you're pre-seed and you're pre-launch, right? So I think I would go back to, are you talking to the right investors, right? Because if people are asking you for traction as it translates into like willingness to pay or turning on monetization soon enough, like some businesses don't do this for like months, if not years, right? And so, question the people who are asking for traction, like, are they truly pre-seed investors? Maybe not. That would be sort of my first, in terms of sort of milestones, it's hard as a pre-seed company to like track milestones or KPIs, or like, you shouldn't have investors who burden you with like a set of 10 KPIs that they want you to track. Like that, they're not the right investors for you if that's what they're after. It is helpful to have 2 or 3, like you got to be able to tell me like, if this progresses in this way, right? If that particular metric is trending up, we know we're doing something right? I need one way to sort of have a loop of like, you need to be learning, right? It's fine to be doing 10 different experiments and like not knowing what will work, really, totally cool, but given the stage that you're at. But you got to be able to have 2 or 3 things that you're tracking where like, if it's trending in a direction, you'll be like, well, we thought this would do this. It's doing this other thing, we're going to stop that. Or, oh my God, this is really picking up. We didn't expect that, but this is apparently where we should spend our time. So be ready to have that and report on that. And it doesn't need to be like a number of metrics, a number of users, right? Whatever you do, pick metrics that demonstrate that you understand your business in and out, right? Like you see this concept of like daily active users everywhere. My first question always is, how do you define that? Right? If the person like opens up the app but does nothing else, that I don't care. You can have, hundreds, thousands of daily active users. If you define that as like the person has opened the app today, all right, well, how long do they do something? Do they do one thing? What is the one thing that they need to do to be considered active? And I think it just gives you a good sense for like the founder full of crap and just like, wants followers on Twitter. What does that drive? Why is that important that you have this traction as it translates into like followers on Instagram or wherever they are? Like, why does that matter to me? Can anyone else have that too? How did you get there? why are they following you? What is that interesting, right? Like the number in and of itself is just a number. The quality of that number is much more interesting to me. And I think you'll find that the depth of conversations with investors and the people who read your newsletter and be like, "Ooh, this is really interesting to me," will change dramatically.
Thank you. That was extremely helpful. I appreciate it.
Great.
I love that answer. I've worked with so many businesses where we have so many active users or so many millions of impressions. Like, who cares?
Yep.
Who cares?
Virginie, I just wanted to say thanks for hanging out with us this long. And I do have a question again. This will be from your perspective. When people are doing either pre-seed, seed, stage one investing, what are they looking in return at each one? Like, is it a percentage on their investment money back to them? Is it some type of shares in the company? Just trying to get a sight on that a little bit.
Yeah, so there's generally speaking, two answers to that. At a very high level, VCs are looking to return 3 times net capital back to their investors, right? So if someone invests in my funds, $10 million fund, net of fees, right? 2% management fee, 20% carry is pretty typical, although I'm structured differently. Don't need to get in the weeds, and I do have to run. But generally speaking, after I've paid my 2% a year and my 20% carry, right? After I take that, 3 times net back, right? So you need to think about that in terms of like, if I invest in 40 companies, how many of them can fail, and what does the rest of them need to do so that I can continue to return that 3x? Usually that means that if 0.5% of the portfolio goes to 0, the rest of them go to 10x, right? So my return expectations are actually pretty high. Again, generally speaking, investors tend to underwrite every investment, trying to understand whether they can return the fund, right? And so in my case, that means whatever percentage of the company I'm going to have at exit, can that translate into at least $10 million? That's a tall order, knowing that I cut 200K checks that get me, 1-2% of the company today, assuming a certain number of dilution at each round, right? That means that I'm going to be very sub 1% of the company at exit. Like, what type of exit do you need to have for me to get 10 million out of you, right? Just think about that, and whether the VC route is appropriate for that. So that's one way. In terms of sort of target ownership is sort of what you were referring to. It depends if you have a follow-on versus a no follow-on strategy. So always make sure you need to ask that questions to investors, right? One, because you need to know, is there more capital where that came from? In my case, it's no, right? I cut one check and I'm done. That's for alignment reasons, right? I like to be very aligned with my founders. After I cut the check, I'm fully on board, right? Like I have zero incentive to tell you anything other than what I think is good for the business, because we both win. But some investors have a follow-on strategy, right? They do, which generally speaking means that they're a little bit more concentrated. They're going to cut fewer number of checks. They look to own a certain percentage of the company when they do cut the check, again, so that even assuming a certain number of dilution, right, they own a certain percentage of the company at exit. And so the way that impacts what returns they're looking for, or the type of check evaluations that they're looking for, is because they need to be a little bit more ownership sensitive, right? In my case, I invest in 40 companies. I have a $10 million fund. I don't need to worry too much about what percentage of the company am I going to own at exit. If I have a $250 million fund and I'm only going to cut 20 checks into companies, like I need to make sure that the one winner in my portfolio, I'm going to own enough of it at exit to return my $250 million fund. That's the dynamic usually that's at play.
No, thank you. Really appreciate that.
Yeah, fantastic. I know we're running over time. Thank you so much, Virginie, for all of your time and wisdom, which I was expecting, which I knew was coming.
Sure.
And thank you, everybody, for being here. And we'll see you in 2 weeks for next Investor Insights.
Thanks, everyone, for having me. Enjoyed it.
Thank you.
Have a good one.
Thank you.